I'm Srivatsa, and I manage the UTI Large and Mid Cap Fund, which is in the large and mid cap category. So it has both the large and the mid cap, which is more than 35%, as well as a decent allocation to the small cap part of the portfolio. Yeah, over to you,
Yeah.
Sonal. Questions.
Thanks, Srivatsa. To start with, could you help our audience understand the investment strategy of UTI Large and Mid Cap Fund and the key elements that shape your investment approach?
Yeah, if you look at the UTI Large and Mid Cap Fund, we have a very distinct value philosophy. And when I say value philosophy, it's not the traditional value. Of course, we have got some allocation towards the traditional value, which is there in the slide. But we look at value from four parameters. The first is relative valuation, where we look at well-established companies available at valuations lower than their long-term averages. The second is mispriced companies across the spectrum of large, mid, and small caps, where the market is probably not anticipating or not recognizing the sharp improvements or the sharp improvement in the ROCE and are available at very cheap valuations. Wherever possible, if valuations permits, we do look at growth, but the valuation is a very, very important criteria for us. So we don't buy growth at any price. The last is what we call pure value is the original value definition of stocks available cheap, stocks available at say more than 4-5% dividend yield, available below book. Historically, they have not proved to be very good long-term value creators, but yes, as and when we see opportunities, we do take some tactical calls in them, but they are relatively a smaller part of the portfolio.
Sure. Since Let's just unpack these elements a bit further. Could you help us understand how you apply these principles in practice? How do you go about identifying businesses that fit within these investment parameters?
Yeah, sure. So if you look at the first one, which I talked about, is established leaders and attractive valuation. Now, if you look at the last many years, you see a lot of blue chip companies like say an Infosys or a Sun Pharma or an ITC. You can name any company. They hardly trade at the same valuation over a longer time frame. Sometimes they trade much above mean. Sometimes they trade much below mean. Now, the reason is that they are also, bounded by what happens on the macro. Like, say, for example, today, what is happening in the IT side? There is a kind of a weakness in the IT because of the threat of AI. So the valuations have come down meaningfully. Sometimes it could be company specific, where some of these companies are facing challenges on account of some internal issues. So these could be all short-term issues. However, the markets does punish them in the short term if they don't see the earnings visibility or they are, worried about something, what's happening on the macro side, which kind of impacts their business. Hence, there is a chance of us getting these companies at very favorable valuations vis-a-vis the longer term, valuation range. Just to give some examples, if I take through these four companies, I'm sure all of you would agree that they are the best in class companies which have generated humongous, wealth over the last 20-25 years. But if you look at the valuation ranges over the last 10 years, they've seen very, very wild swings depending upon the situation at that particular point of time. So for example, if I take Infosys, I go back all the way back to 2013 or even 2017, there were some worries on the IT spends. The company reported a couple of weak quarters and the markets did punish them. However, 3 years later, or 4 years later in December 2021, they also got one of their highest valuations in the last 15, 20 years because the outlook improved considerably. They were making record profit margins. The same thing goes with Sun Pharma, ITC. So in short, I think you would find a lot of high quality companies trending at lower valuations because of certain short-term issues. And that's the time we come and step in. So I would say it's more something like an anti-momentum that, we are convinced that these companies have created a great long-term record. We know that it's just a blip and they will resume their journey once a certain time frame passes by, and we stand by them and we increase our allocations in these companies. The next one is probably the reverse of the first one, in the sense that the first one have created great long-term track record. The second one may not have a very great long-term track record, either of certain issues in the past. But what we look out for is whether there's a massive change in the improvement. We kind of look for various signs. There's an improved governance, better operating metrics, change in the regulatory environment, or focus on shareholders' value creation. Once we are convinced that there is a change, of course, most of these companies would be available at a very reasonable valuations because they have not been able to create a great long-term value. It's all under-owned. Investors have given them a pass. We are very careful in our stock selection here. So we don't probably, if we identify 10 such stocks, we would probably get into them only in two, three of them. But the idea is to get into them only when we are convinced that there is a improvement happening on those parameters. It's not a valuation call that the stocks are cheap. So I think this is one of the key elements of our strategy, which has kind of worked very well for us in the last 3 to 5 years. The next one. So here are some of these examples. These stocks have not probably created great long-term value a couple of years back, but we saw a change in the business model, a change in the management, or a kind of a change in the shareholders' allocation strategy, which kind of helped us generate a very decent alpha in these kind of stocks. Yeah, next one. I think the third one is, as far as possible, as valuation permits, get into growth-oriented stocks. But I would say in today's environment and probably in the last 3, 4 years, it's been very hard to find, at least in the large and mid-cap space, a growth-oriented stock available at a reasonable valuation. So wherever possible, we try and scan through the small cap space to find if we can, find any kind of stocks. But again, the main criteria is what we pay for it. We don't want to overpay for the growth. So we ensure that, whatever we pay for it is reasonable. Next one. Again, in terms of the small caps, our focus is to ensure that because this is the riskier part of the portfolio, our focus is to ensure that we get into decent quality small caps, high quality small caps, and we do a lot of due diligence on them. And it's also spread out. So, for example, the weightages could be 13 to 14%, but it's spread out across 18 to 20 companies to ensure that the risk is kind of minimized as far as the small caps part is concerned. Next one. Again, some of the illustrations of our growth-oriented small cap companies. Some of them are not very well discovered. I think that's what we prefer getting into. But we do a lot of due diligence here, far, far higher to ensure that, it meets all our rigorous quality parameters that we have set for ourselves in the small cap space. Next one. Coming to the last one, this is what I called a pure value. As I said, it's available cheap, high dividend yield, a low P ratio, sub 10 P ratio, below book. But what clearly we look out for is not the valuation. We look out for other key triggers. Just to give an illustration, if I were to buy an upstream oil company, what I would look out for is not there's always been available at say 4 to 5% dividend yield. But if there is a trigger, for example, of a production increase in the oil fields compared to say a 2-3% decline, that's something that I would look out for. And so all these companies which are value oriented, which would be the typical, as I said, available below book or any of those traditional value parameters, I need to see some other trigger apart from valuation for me to get into it. And also, this is not a very large part of the portfolio. We generally allocate maximum up to 10% in this category. And we are very cognizant of the risks of being in this category in the longer term. But yes, we get in when we only see triggers apart from low valuation. And we are also quite adept in kind of getting out if that kind of story has played out. The next one. You can skip this. Just to give a couple of illustrations on how we have been able to capture it. Look, if I look at the IT sector, In the beginning of COVID, when the valuations were down, we increased our allocation there. And then in 2021 end, when the valuations went up in a very big way, we actually went underweight. And if you look at the last 7, 8 months, this trade clearly hasn't played out in the last 4, 5 months, but we generally invest with a medium to longer term time frame. Again, as the valuations have trended down in the last 3, 4 months, we have steadily been increasing our allocation in the IT sector. So this clearly reinforces the valuation discipline we have on both ends, like back it when the valuation comes down and when our belief is that there will be a kind of a mean reversion, and at the same time when the valuation goes excess, cut your positions, cut your overweight positions and go underweight on it. Other one is, I think, capital goods, which is one of the most expensive sectors. If I look at the benchmark, we did have an overweight position 3, 4 years back, when the valuations were much, much more reasonable. But in the last 2, 3 years, we have barely had any positions. I think we are underweight to the extent of 75, 80%. Again, reinforcing our very strong value discipline that we do not want to get into sectors or stocks where the valuations are far higher than the mean.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.